I wanted to start with, Matt sort of alluded to it, but I can't think of a country that has transformed itself, or a society or an industry with such speed and such scale. And you've gone from no cinema to being a hub for the film industry, post-oil economy, more than doubling the participation of women in the workforce in just a few years. So I think of that movie, Everything, Everywhere, All at Once. Can you give us some sense as to why this scale and the speed?
What happens when the world's richest oil nation can't afford its own future? Even before the recent collapse in oil prices, Saudi Arabia's Vision 2030, the bold blueprint to shift its economy away from oil, was already running into serious trouble. Massive cost overruns, dwindling foreign investment, and ballooning budget deficits had put the kingdom under pressure. But the post-Liberation Day oil crash has made things dramatically worse. Earlier this week, Saudi Arabia's finance ministry quietly revealed that it borrowed more in the first quarter of 2025 than ever before, a clear sign of financial distress. In this video, we're going to break down what's behind the recent oil price crash, how it fits into the Saudis' $100 a barrel strategy, and what it could mean for the kingdom's economic future. To really understand this story, we need to zoom out. Saudi Arabia is one of the largest oil producers in the world and its single biggest exporter. Its economy is overwhelmingly dependent on oil. The sector contributes roughly 90% of export earnings, 80% of government revenues, and 40% of total GDP. And even much of the remaining 60% of GDP still indirectly relies on oil-funded government spending. At first glance, that might sound like a blessing. After all, who wouldn't want billions in oil income? But in reality, this dependence on oil creates both political and economic vulnerabilities. Politically, oil simply can't generate enough jobs to keep pace with Saudi Arabia's rapidly growing population. This has led to severe inequalities between those employed in the oil sector and those outside it. To keep unemployment at politically acceptable levels, the government has resorted to essentially creating jobs, which is why about 2/3 of working Saudis are employed by the public sector. Economically, this reliance has crippled the competitiveness of Saudi Arabia's non-oil sectors, a phenomenon known as Dutch disease. Over time, it makes it incredibly difficult to build a diverse, sustainable economy. And even if oil demand holds up for the next few decades, the economy remains dangerously exposed to wild swings in oil prices, making long-term economic planning nearly impossible. Just to illustrate how volatile prices have been, between 2007 and 2011, oil prices doubled, then halved, then doubled again, before collapsing in 2014 and even going negative in 2020. To tackle this structural weakness, Crown Prince Mohammed bin Salman launched Vision 2030 back in 2016. Goal? Reduce the kingdom's reliance on oil by building a robust, non-oil economy. In practical terms, this involved two major strategies. First, boost Saudi Arabia's export-led sectors like tourism, mining, and manufacturing until they become internationally competitive and not dependent on oil subsidies. Second, stimulate the domestic economy by investing in education, infrastructure, and small businesses, all aimed at increasing local demand and reducing reliance on imports. This was never going to be easy. Few oil-dependent countries have managed to successfully diversify, and those that did, like Norway, took decades, investing oil revenues slowly and steadily. Saudi Arabia, by contrast, has set an extremely tight deadline. By 2030, the kingdom aims for the private sector to contribute 65% of GDP, half of which must come from small and medium-sized enterprises. Non-oil exports should make up 50% of total exports, and renewables should generate half of the country's electricity. Reaching those targets so quickly was always going to require massive funding. That's why, after the pandemic, Saudi Arabia made a deliberate push to drive oil prices up to $100 per barrel, ensuring enough cash flow to fuel these ambitious projects. This, too, was a stretch. From 2015 to the pandemic, oil hovered around $60 per barrel. Still, the Saudis were hopeful. Thanks to OPEC+, the expanded oil cartel that includes both Saudi Arabia and Russia, they had significant leverage over global prices. Yet, the plan didn't unfold as expected. Post-pandemic, oil prices settled around $80 per barrel. Why? Partly because non-OPEC production surged, especially from countries like Canada, Brazil, Guyana, and the US with its shale boom. At the same time, the Biden administration actively worked to keep oil prices down by releasing supplies from America's strategic petroleum reserve whenever prices started to spike. This sparked growing tension within OPEC+. Members began resisting further production cuts. Angola even left the cartel last year, and others, notably Iraq, Kazakhstan, and the UAE, quietly produced more than their quotas allowed. Saudi Arabia, frustrated by this lack of discipline, was forced to take drastic action. It unilaterally slashed output by 2 million barrels per day, reducing its oil production to the lowest level since 2011. This came at a steep cost. It meant sacrificing short-term revenue at a time when Vision 2030's mega projects, like NEOM's futuristic Line City and the new Saudi Football League, were driving public spending to record levels. The result? Soaring budget deficits. According to Bloomberg Economics, the kingdom's break-even oil price, the price needed to balance its budget, rose to around $110 per barrel. That's why the recent crash in oil prices, which have now plunged to around $60, is such a blow. The immediate trigger for the crash was Trump's Liberation Day, which dampened global demand forecasts. But the situation was worsened by Saudi Arabia's decision to roll back some of its voluntary production cuts, a quiet admission that the $100 a barrel strategy has failed. If prices stay at current levels, Goldman Sachs estimates the kingdom could run a $67 billion budget deficit this year, more than double the government's official forecast. And it might get worse. On Tuesday, Saudi Arabia's finance ministry acknowledged that the kingdom had borrowed a record-breaking $30 billion in just the first quarter of 2025. If borrowing continues at this pace, Saudi Arabia could end the year with a deficit nearing $120 billion, about 11% of GDP. That would rank among the highest deficits globally. To be fair, Saudi Arabia still has substantial reserves and a relatively low debt-to-GDP ratio, around 30%, well below most advanced economies. But the cost of insuring Saudi debt against default has now risen to its highest level since 2020, and the government is under pressure to avoid digging too deeply into its foreign exchange reserves, which are vital for maintaining the Saudi rial's peg to the US dollar. Meanwhile, persistently low oil prices will likely force Crown Prince Mohammed bin Salman to dramatically scale back Vision 2030. Public enthusiasm is already fading. Flagship projects like NEOM have suffered repeated delays and are undergoing reviews. And foreign investors, once intrigued by the kingdom's ambitions, are now backing away. The real risk for MBS is this. If oil prices remain low, he may be forced to scale back Vision 2030 so severely that the plan becomes unrecognizable and the country slides back into full dependency on oil. With that said, thanks for watching, and until next time.